Hey folks, it's Dave Burrows, and I want to welcome you to this week's version of Barometer Readings webcast. I am CIO and CEO here at Barometer, and we use this webcast each week for a couple of purposes. One, to be transparent about what we're doing, to talk a little bit about what we see going on in the market, to retest, our views as to what's working and what's not. Our job is to make sure we keep our portfolios fresh and in tune with what's going on in the market. And just the sheer process of going through and preparing for this webcast every week, makes us ask the question, has something changed? We've got a busy team here who, of course, are on top of the fundamental research of the individual ideas. My focus is the top-down sort of macro view of the world. And between those two things, we want to be able to reevaluate every one of our positions every day using some tools that are kind of repeatable and looking at things through those lenses. So as always, I want to start sort of from the top down. We think we started a bull market in the US in 2013. It's over 10 years now. Secular bull markets go on for a long time, 15, 18, 19, 16 years. And it's not without interruptions. You have very significant pullbacks and cyclical bear markets during those periods. But generally, a secular bull market is where an asset class is being revalued versus other assets that you could own. And at some point, toward the end of a secular bull market, you get to a point where the asset class is overowned and overpriced, and probably sentiment is way too bullish. And then something changes and money starts to rotate to other types of assets. So our job is always to be asking the question, first of all, are we focused in the right asset classes? And I would say the equity asset class is one that has been strong, but is getting stronger. And we're going to talk about that as we go along today. Just looking at the last two secular bull markets, the 80s and the 90s, and 2013 through the present, we've been able to stay above this rising 200-week moving average all the way along. That is typical in a secular bull market. A secular bear market, you can see crisscross back and forth, covers a lot of ground, doesn't make a lot of progress. And I don't want to minimize it, but that was the tech wreck and that was the financial crisis, and nobody wants to go through those fully invested. So we always have to ask the question, are we positioned properly? I think the most important thing just from this chart is the fact that we have exceeded the highs from 2021 after almost a 2-year bear market. And we are making multiple new highs over the last 6 weeks. Market's up about 4.5% so far in the month of February. We're just about to the close here. Some areas better, some areas worse, but it's a constructive market. When we exit these boxes, you tend to have 2 to 3 years of running room in front of us before the next major correction. So that's a really bullish thing. And it's one of the reasons why we've been talking to clients and saying, yes, market's been pretty good recently, but if people are sitting on cash, this is not the time to be doing that, right? I think that money is rotating from fixed income and it's rotating from cash. And I think that there is likely a good, period of time that we have to make up some pretty positive returns over the next couple of years. If we look at the short-term picture, this is the 24-month bear market we went through. This is the October low. You can see the market has been marching higher almost relentlessly since then. That's the S&P 500, and of course, dominated by some very big stocks. But, we're going to talk today. This market has become a lot more broad. There's a lot of things going on. Here's an interesting statistic, and this is from our friend Ryan Dietrich at Carson. He does a lot of historical studies, and I use them often. But if you go back to 1950 and take every year where November, December, January, and February were positive, the next 12 months following that tended to be exceptionally strong. So an average of 17.4%, and it ranges the low end at 5%, the high end at 40%. Wouldn't that be nice? But the net of it is, it tends to be when you get that persistent strength. It's not like a one-shot wonder. This is the beginning of something important, and it lines up with the fact that we've just taken out, all-time highs. So just quickly, we know that the US stocks have really outperformed the rest of the world. We've been talking about this over the last few weeks. You know, that other markets are starting to wake up. We talked about the fact that US stocks on average are trading at about 20.1 times forward earnings, or the estimates for the next 12 months, versus, you know, in case of Canada, 13 times. It's a pretty big distribution difference. If we look at the earnings yield of the average company in the Canadian market versus the 30-year bond yield, you're getting compensated for taking risk owning stocks versus bonds. There is not that same spread in the US. They're trading at literally the same earnings yield versus bond yield. So Canadian market tends to look a little bit less expensive. It's interesting that we have taken out, after a very significant back and forth over the last year, taken out those areas of resistance, and the Canadian market's been marching a little higher, putting it into a bigger view, 2007 through 2020. Well, that's a secular bear market, just like we looked at in the US market between 2000 and 2013. You know, we came out of it. We've consolidated through the global tightening cycle, 1, 2, 3 for the last 4 months, sort of starting to blast off. So when we talk about these things, it's important to look at the big picture. It's great that Canadian stocks are doing better. It's way more important that we've exited a very long period where there was no return, you know, other than sort of tactically. And it speaks to the fact that we're probably early stage as a new bull market. Now, the Canadian stock market tends to be more correlated to global stocks than it is to the US market for a couple of reasons. Two big sectors in the Canadian market, you know, financial services and industrials, and then you throw energy in there, it starts to look a lot more like global markets. And we know that money's been leaving the Canadian markets over the last couple of years. Just started to see some money come back in, so you know, we'll see. But my guess is that's probably early days of something more like this or more like this in 2008-9. If you look at U.S. stocks versus global stocks, the MSCI World ex-US, this is the index that we've paired our global equity fund against, which, since it's begun, is outperforming as we hoped it would. But we think that, again, there's some room in global stocks for the first time in many years. You know, this differential is as big as it's been going back to 2000. So very big discount for global stocks versus US stocks. And same thing, you know, it looks like for global stocks, the long-term bear market has come to an end. This is Japanese stocks. You may have read Warren Buffett in his letter this year talked about the fact that he not only made significant investments in Japan, but he's doubling down and adding additional weight to his Japanese holdings, especially the trading companies, aka financials, right? Financials are 22% of the MSCI All World Index ex-US. It's the biggest sector weight, the biggest sector in Canada, biggest sector in Japan. It's a big sector in other places, but when you exit these long sideways periods and you begin to rally, it generally is the beginning of something bigger. We're seeing that in India. We're seeing it in Europe. Again, biggest sector weights, financials and industrials. And we're seeing a shift in the Brazilian market, very different, you know, long, difficult bear market from 2008 through 2022. And we're just starting to poke our heads up here. So some of the EM markets looking a little bit more interesting also. So let's move forward to bonds. You know, we talked about the fact we saw a generational low in interest rates after 40 years of falling interest rates, much like we did after the falling interest rates through the First and Second World War. And once they started to rally for quite some time. I know that the expectation is that rates are going to back up, and that wouldn't be impossible because, you know, it doesn't go straight higher. We see rates move higher in fits and starts, as I say. But when we look at the bond market, you know, this is the US Treasury bond. The price at the bottom was down 53%, really not much up from that. The aggregate bond index is still down 17% over the last 3 years. and really not making any progress. So if we compare stocks versus bonds, very clearly, this is the SPY, the ETF for the S&P 500 versus the aggregate bond ETF AGG. You can see this has been moving higher, meaning stocks are outperforming bonds. And that includes the bear market in 2022. Both were down about 21%. So there's a reason why money is slowly moving into equities. Rates may be a little bit stickier. People looking for ways to fight inflation. Companies can raise price. A bond is fixed income. Cost of living goes up, the income does not. So we think there's a mountain of money in the bond market, roughly 10 times the size of the stock market is the bond market. We only need a little bit of money to decide that it doesn't want to be there anymore and wants to move into stocks to have a significant impact on the stock market. And we know it takes people years to reposition their portfolios. More importantly, when we compare dividend growth stocks, the RDVY ETF, to high dividend paying stocks, which we call bond proxies. They don't really grow their income, but they're nice high dividends. Again, you can see since the market low back in 2022, dividend growth stocks are outperforming high dividend stocks, which means for us as income investors, we're avoiding fixed income. We're avoiding high dividend paying stocks. We're focused on companies that generate so much cash they have an ability to regularly raise their dividend, and the market is clearly voting with its feet in this direction. We think that's the beginning of a long-term theme. So since March of 2023, the equally weighted S&P is up about 18%, TSX up about 14%, the aggregate bond index, or an aggregate of issuers and maturities, up 1%. Our high income portfolio up about 19.5, our equity portfolio up about 26, and our macro portfolio up about 16. So these themes, I think, are working well, and they're not showing any sign of giving up the ghost. So when we look at this period, a lot of people out there think that higher interest rates are bad for stocks. Well, I want to just challenge that for a moment, because from 1951 to 1966, this period in here, there were no crises, there were no major panics, a couple of small recessions, and stocks went up 15.1% a year, while bonds gave roughly an inflation number. So if you took tax off, you'd be behind. And the 5 best stocks were dividend growers. So I'm going to keep putting that up, because this, as long as this theme is in gear, it can really have legs. It could go on for years and years. When we go beyond stocks and bonds, commodities, continue to, I think, to have a pretty good setup after a very long period of underperformance. They had a great period through 2000 and 2021. Through the Fed's tightening cycle, they certainly have consolidated. But even in the last couple of months, we started to get up out of that consolidation. Again, putting into question those that think that we are headed into some kind of a recession. If we compare commodities versus bonds, this is the USCI index versus the aggregate bond index. Very clearly, commodities are outperforming. So when we look at sort of broad asset classes that we want to be focused in, equities clearly are an asset class we want to be in. Global equities are a group that have become a lot more interesting after many years of underperforming. Commodities are an area that we have to be taking a look. Frankly, they're a type of asset that helps offset inflation and would go up as a scarce asset. When you go through a long-term bear market, companies stop investing in capacity. And when demand comes back, it takes a long time for new capacity to come online. So copper, after a very long bear market and consolidation, looks like it's very close to waking up, just coming out of that consolidation. Gold, interestingly enough, if you look at the really long-term picture, 2012 through the present, just starting to poke its head up. This has been over the last 4 months, a very, very tight range. And I can understand why people would get frustrated waiting. If we get up and out of this range, my guess is there's probably some fireworks. So commodities not well owned, but one that we want to keep a close eye on. Now, some a little bit more controversial. I'll talk about Bitcoin for a moment. I think that we can't avoid it. This is an asset that is becoming democratized. We've seen a number of different Bitcoin ETFs launched. And I just want to show that, it's just another asset class. And it's something that people want to own in a world where governments continue to print money. When we look at 2014 through 17, where it didn't do well, just like other asset classes, when it gets going, it can have a great rally. And we went through a crypto winter 2017 through 2020, another great rally. And it looks to me like we're sort of coming to an end. If we compare how Bitcoin is performing relative to the equally weighted S&P, note that when it broke out in 2016, a big run, on a relative basis, when it broke out in 2020, it had a huge run. And we've recently broken out versus the equally weighted S&P. So, my guess is this could go on for a while. Fundamentally speaking, there is a halving coming up in May. Effectively, it's like a split. It has a tendency to really rally leading into and post a halving. And so this is something that we're watching. And we do have about a 10, 11% weight, which we've had over the last year in our macro portfolio. So we're coming to the end of earnings season. 450 companies roughly have reported. The average company had sales growth of about 4%. The S&P had earnings growth of about 7%. We surprised the upside. The company is surprised the upside by about 1% on revenues and about 7.5% on earnings. Now, the reason that earnings have been important is that there has been a concern that we could see some kind of an earnings recession. And frankly, it doesn't look to be the case. We want to pull the lens back and look at what expectations are going forward. Q2 of 2023 had revenue growth of about 0.5 of 1%, Q3 1.7, Q4 3.4. Look at the estimates for the rest of the year. They look to be rising. And when we look at earnings out beyond 2023, estimates are for 242 for the S&P in 24 and 275. Earnings are ramping. So we're seeing earnings multiples expand and we're seeing earnings go up. That makes stocks kind of attractive. Now, we don't have to be everywhere. Our job is to sort of target the parts of the market that we think are relevant. I like to talk about them on this webcast to make sure that we're targeting productive areas. And that could be specific sectors or themes or geographic regions. We're always watching for new leadership to emerge. And frankly, the market has been broadening over the last while. We'll talk a little bit about that. And in the absence of leadership, we certainly have a willingness to have cash. We don't have cash currently, right? Tactically speaking, things look quite attractive in the near term and have done so for almost a year now. Our work is driven by three basic pieces. One, we spend a lot of time top down looking at the various neighborhoods we could focus in to try to identify parts of the investable universe that are seeing new inflows of capital. Where is money being put to work today? And then within those groups, we try to find specific securities out of all of the publicly traded securities to use to express our view to get our exposure in those groups. Now, if 70% of return comes from getting to the right neighborhood, the right asset classes, like, say, equities, and the right sectors or themes, 30% comes from finding securities that are better than the rest. And through this process, through looking at 60,000 securities every day, through retesting our theses, doing our due diligence, our job is to keep this portfolio fresh. And the way we do that is by using stop losses on individual securities to make sure that little mistakes don't turn into big ones, and to be willing to trade up. If a position is not doing poorly but is underperforming other opportunities, we're always willing to trade up as we can find new ideas. And frankly, one of the problems we have right now is it's a bit like drinking water out of a fire hose. There's a lot of things that have started to perform quite well. In general, we're looking for parts of the market where over time a higher and higher percentage of stocks are performing well. That means money's getting put to work. There's no way around it. You can make all the arguments you want as to why it shouldn't be happening, but if it is happening, it may be you that's missing out on something. We do as much work as we can do to figure out why things are performing the way that they are, but it will never be the case that we are going to fight what's happening in the market thinking that we know better. That's the road to destruction. Late and in advance, you get to a point where almost everything's working. And then at some point, bread starts to narrow, meaning the weaklings start to peel away. That's our early warning. Generally, the leaders don't get hurt at the beginning. It's the weaklings first. But if bread starts to narrow, it tells us the ice is getting thinner, and we should stop putting any new money to work in that area. We should tighten up our stops and reduce our tolerance for risk. So we spend a lot of time trying to identify where breadth is expanding and where breadth is contracting to make sure that we are examining the portfolios to make sure they're structured for the current market. Okay, so as we sit today, about 60% of stocks in the US are in clearly defined upward price trends. If we were to go back to October of this year, it was 18%. So there was 18% of stocks, even at the worst point, that had held up in price. That's a pretty good indication they're doing something right. And since then, the percent of stocks has generally been rising, the percent of stocks performing well. It's pulled back about 6% over the last 3-4 weeks. Not significant, but something just to watch. In Canada, we've seen pretty consistent improvement, and globally, it's been very steady improvement. We look at the percent of stocks with positive weekly price momentum or upward trajectory. Again, it was up again this week. Percent of stocks making new highs versus the number of stocks making new lows continued to expand. The new high list is getting bigger. The percent of stocks trading above their 150-day or long-term moving average, a good arbiter of long-term trend, is expanding steadily. So in general, we would say breadth conditions have been getting better. Now that's looking at it stock by stock. We got to look at it sector by sector. Now, first of all, from a price perspective, the S&P 500 market cap weighted since October, sharp move higher. You can see higher high, higher low, higher high, higher low, higher high, higher low. This is an uptrend. It's no way to argue it. And recently we've just exceeded and made another new high. Now, one argument might be, well, is the equally weighted index doing the same thing? Or what is the average stock doing? A lot of people say it's just the biggest stocks that are performing well. Well, again, since the end of October, B is November, higher December, pull back in January, higher high in February, higher low in February, higher high in February. So now you can see off point figure charts, the targets are a fair bit higher. That's an opinion that some people have. We just take this day by day, but now let's look at the sector work. So in our opinion, the leading sector in the market currently is now the financial services sector. And this is made up of fintech. It's made up of insurance. It's made up of some banks. There's a lot of different things in the financials sector. This is the financials ETF XLF, which is a broadly based ETF. It's up almost 29% since the end of October. It's a very sharp move higher, but again, if we take the lens back, look at the length of the bear market in financials from 2007 through 2021. So the fact that it's only just getting going is probably really substantial, which helps to make the case for why global stocks look really interesting, especially because they're trading at the biggest discount to US stocks than they have since the year 2000. Let's look at some underlying parts. Now, we spent a lot of time talking about insurance over the last year. This is the fall of 2022, a higher low in March, a higher low in May, a higher low in October. And look, we went on to make, sharply higher highs. And this is on the backs of companies like Fairfax. What a resilient stock. Now, this is about the biggest company that the biggest position that we have as a firm. We were obviously concerned when Muddy Waters 2 weeks ago came out and questioned the pricing that they have on their private company holdings. They came out and made their explanation. Look how quickly it recovered back to make a new high. That's the sign of a resilient stock. Now, property and casualty companies are doing particularly well because ultimately they're just big investment portfolios. And on the other side, they pay out claims as they are needed. But if insurance premiums are hard, meaning that prices are going up and the returns on their investment portfolios are good, then insurance companies tend to be a great place to be. They tend to be a good place to be invested in a more inflationary world. That's Fairfax. We've heard a little bit about Berkshire over the last little while, a little company led by Warren Buffett, trading better than 82% of companies in the S&P. Not quite as well as Fairfax this year, trading better than 89% of stocks, but a pretty darn good one. And they're benefiting from the same way. In life insurance, Manulife, get this breakout in Manulife. We bought this back in November as it cleared through these highs, and has certainly had a great run higher. Market really liked the earnings recently. Capital markets banks, companies like Morgan Stanley and Goldman Sachs acting well, asset managers. And so the financials are a group that we want to continue to focus in. Industrials. After consolidating through the bear market, industrials made new highs in November and been working their way higher since, up 27% since the October low. And this is interesting because this group is not well owned. It's a group that you would want to fade if you thought there was a big recession coming. Yet, frankly, it's acting really, really well. One of our biggest positions, top 10 holding, is Stantec. Stantec does engineering for infrastructure projects, also for mining companies and governments. Stock's just been marching along, making acquisitions, tuck-in acquisitions in the business that they're in. Howmet, which we've talked a little bit about in the defense sector, very, very strong. In fact, it's one of the 10 strongest companies in large cap stocks in the US. Eaton Corp marching higher. Waste Connections, which we bought as it broke out here in the end of December in the waste business. That business is completely dependent on your ability to price and underlying economic strength, the quantity that these companies are picking up to get paid on. So very simple test. Transports versus utilities. During the bear market, people focused a little more on utilities. Since October of 2022, transports well outperforming and breaking out on a relative basis. So who would you rather own in transports than Uber? Now trading better than 97% of companies in the S&P, and just got added to the Dow Transports. We think we're in a world where winner takes most. And Uber certainly has a dominant position. CP Kansas City has just taken out all of the previous highs, trading better than 80% of stocks in the S&P. And this you can't see very well, but I thought it was interesting. This I found on Twitter yesterday. Larry Tentarelli does a really good job at looking at high relative strength stocks. And he highlighted that 4 of the 6 large cap strongest stocks from a relative strength perspective are in the industrial sector. And of the top 12 companies, large cap companies based on relative strength, only 2 are from the tech sector. So the market is broadening out. Other groups are participating, financials participating, industrials participating. And, the large cap tech ETF XLK has had a great run, but look, relative strength has basically been flat since October, actually flat to down, meaning it's not outperforming the rest of the market. Some stocks are doing better, some worse. You can see Apple is 22% of the XLK. It's actually trading down around the 200-day moving average. We came out of that in December. But NVIDIA did a great job in their report last week. We had a big gap higher. Microsoft, relative strength is waning a little bit. But they have a really dominant position in their AI franchise. Broadcom continues to act really, really well in the semiconductors, and Meta just, blew their numbers away and trading better than 97%. So it's about picking your spots. So a few more groups. Materials. One group that you would question if you thought there was a recession, just starting to come out of a consolidation here. There's been some strength in chemical companies and some aggregate companies over the last few weeks. We're going to watch that. Metals and miners starting to come out of their consolidation. Again, probably taking a little bit more time because, the view is that the Fed may be a little bit longer to cut rates, but big opportunity there. You can see this goes all the way back to 2011. Cameco, which has been a big position of ours, pulled back a little over the last 3 weeks, but just pulling back into the moving averages, had a rocket ride over the last 3 years. This is one that we think probably continues to do well. And energy, seasonally, it's the time. And look at Imperial Oil. After consolidating through the Fed's tightening cycle, breaking out, and now making new all-time highs. So CNQ is coming in right close behind. Suncor looks very, very similar. Energy looks like it's doing well. So you can see the problem. There's a bunch of sectors doing well. And it's great. It's great if there's a couple of sectors really performing well, but it's a lot better if there's a bunch of sectors performing well. Pharmaceuticals, breaking out of a nice base. And this is a daily chart of the last year. Equally weighted biotech stocks starting to blast off. So a lot to do. In fact, 70% of stocks in the healthcare sector are now trading above the 200-day moving average as the whole healthcare sector is starting to lift off. So you probably hear it in my voice. This market is not getting weaker, it's getting stronger. More and more sectors are participating in the market's rally. And then we watch the groups that should do well if things get worse to see if they're changing. Well, there's the utilities in light blue. Relative strength versus the market continues to make lows. Real estate investment trusts, highly dependent on cheap credit. Well, rates are pretty firm and relative strength is pretty weak. So going back, dividend growers relative to high dividend paying stocks are the name of the game. In our portfolios and the conversations that we're having with clients are pretty straightforward. One, we have one balanced pool that has to have a fixed income component. We are asking clients to reduce the exposure that they have to a balanced portfolio because it has to carry fixed income. Our tactical income portfolio is virtually all dividend growth. Now it can be in different places, but it's dividend growth today and has been since March of last year, up about 19%. This doesn't show any signs of waning. We're asking people to take a 5 to 10% weight in our global equity portfolio, equities outside of the US. They're inexpensive. They're in the right sectors, financials, industrials, and energy. And we think that there's an opportunity starting where we may be into a 10 or 15-year bull market in global stocks. As a firm across the board, financials continues to be our biggest weight, and it continues to grow, not so much because we're adding new positions, but it's just outperforming. Technology came down in weight a couple of percent over the last 2 weeks. We got stopped out of Palo Alto Networks. Stock reported its earnings. They reported a slowdown in demand for cybersecurity. You can't win them all, and you got to have selling discipline. So we came out of the stock the next day. Our weight in industrials continues to grow. Focus on the leaders. Energy is an overweight. And then you can see the defensive sectors, utilities, real estate, government bonds, more cautious. Communication services, which includes Meta, but it also includes the telcos. That's an underweight. So we continue to do this regularly. A few things to take away. When the market makes new highs, when it's gone longer than a year without making one, a year out, things tend to be pretty good. There's a lot of money market out there that can work its way into equities. The flows are positive through until the end of May. That's the typical annual flows in. Credit spreads continue to narrow, meaning bond investors are demanding less and less excess return to buy a corporate bond versus a government bond. That means they're not concerned with credit risk. And volatility is in the low range that it tends to be in during cyclical bull markets. So a few things to take away. VIX today broke down, not higher, broke down. That's another positive. A few other things to keep in mind in the very near term we're watching. At the end of this month, likely there will be some selling by pension funds. Stocks have outperformed bonds so much that they tend to rebalance. It'll be about 33 billion for sale. It's not so much what that number is as how the market will handle it. So we'll watch that closely over the next couple of days, see whether the market can absorb it well. We know there's a ton of buybacks that have restarted now that the earnings are over. Companies have been very confident about buying back their shares. And the last thing we're watching is the US dollar. The US dollar tends to rally when people are nervous. They're looking for a safe haven. The dollar rallied all the way through the 2022 bear market. And when it rolled over, stocks started to rally. Well, you can see that it rolled over again at the March lows in 2023 versus world currencies. Stocks rallied. It rolled over in October, in the October low. And it looks like it's trying to roll over here. So that would be really positive for global stocks and for energy and basic materials. We'll see whether they can get up ahead of steam or not. So the upshot is, I think things look pretty bullish. We can get a pullback at any time. You can always get a 5% pullback. Market seems to be well set up to absorb bad news given the breadth of the advance we've seen over the last while. And then I saw this morning, and so just wanted to raise it. This comes from our friends at Strategas. These are things they watch for signs of a top in the market. So none of these things are checking off. So no major blow off top seen in the market. Net inflows into equity mutual funds and ETFs are in fact underwhelming. They're not a mania going into them. There's been no big pickup in mergers and acquisitions. There's been almost no IPO activity. Tends to be lots of IPO activity at the market top. There's rising real interest rates are not rising. Weakening forward earnings revisions. In fact, revisions are positive currently. An erosion in the number of stocks making new highs. That's a measure of breadth. Well, breadth is expanding significantly. A shift toward defensive leadership like utilities or REITs. Well, you'd see from the pictures today, it's just not happening. And a widening of credit spreads. Well, we're seeing a narrowing of credit spreads. So you can understand why we're invested. You can understand why we see lots of opportunities. If things start to weaken, we got a history of playing defense, but I don't think now is the time. So with that, if I can find any questions, I'm happy to answer them, but we certainly appreciate you guys tuning in today. So let me see if we've got any questions in the queue. Says no audio. I certainly hope that's not the case. Okay, so a question: if there is there an ETF that would suggest Bitcoin? I think the one thing that you want to look at is what the fees are. Grayscale is the most expensive ETF. It's the biggest one. It's I think about $40 billion in size. There's a number in Canada. There's a number in US. I think that they all look pretty decent. They all got approved basically at the same time in the US on the same terms. Next question. I just had a GIC expiring, leaves me with a fair amount of cash, about 9%. Would you suggest Canadian dividend growers rather than US dividend growers? I think that you could use a combination. One of the things I think is unique about the Canadian market is we have some really great dividend growers in the resource producers, companies like CNQ or Imperial Oil. I think that they could be a really good place to focus. I saw a great list outside of the stuff that we've got in our income portfolio, which is looking like the dividend growth will be something around 15% this year in the portfolio. That's one that we try to keep fresh. You can look at RDVY in the US as an ETF. I'm sure there is a comparable one in the Canadian marketplace. Question. What are our thoughts on the Canadian banks? BMO and BNS reported today. they seem to be going in opposite directions. You know, the interesting thing is the Canadian banks are all quite different. We have a lower weight of Canadian banks, I would think, than almost any Canadian asset manager. I think we're about 5% of our total firm assets in Canadian banks. You know, there's some unique issues in Canada. There's, you know, concerns around some of the mortgage books. There's some concerns at a couple of banks on deposit growth and the ability to have cheap source of funds to lend out. We've been more focused and would focus more on US banks. JP Morgan is our big holding. They're the granddaddy of the bunch. They're the one that made a new high in 2013 when it took the rest of the group till 2021 to make new highs. Citigroup, we think, looks interesting also, and Bank of America. That's a longer conversation. Last question is, how do we come up with a sell limit on a stock like NVIDIA? Well, we use a number of different tools. Off the bat, we'd like to see it stay above the 8-day, the 21-day, and the 50-day moving average. We use point and figure charts to help us identify exit points. So that's another common piece. So those four things would be the most important. I think we'll also watch the breadth readings for the semiconductor sector. If we see, you know, significant deterioration in semiconductors, we'll watch it. We'd said last week, you know, it had become about 8% of a lot of portfolios. We did trim it going into earnings last week. You know, you're always sad that you've trimmed a great stock, but it still remains about a 4 to 5% weight of most portfolios. You know, stock looks like it wants to continue to be strong. So onward, I suppose. I think that is all of the questions. So I want to thank everybody for tuning in. I don't have Pamela on here today to thank you herself, but we really appreciate people tuning in. We hope you find these things useful, and we'll be back again next Tuesday. So thanks very much. Have a great week.